Hello, and welcome to Chapter 14 for Macroeconomics, Money, the Federal Reserve, and Interest Rates. So we're gonna look. This chapter is gonna look at functions of money. So which function of money is considered the most important depends on circumstances, but in economics we are gonna focus on medium of exchange. So money is gonna be used to buy and sell goods. We also look at unit of account. So all goods are valued in dollars. Now money does provide a consistent way to value business activity, so comparisons can be made. Without money, trade would be difficult, as each party would have to seek out someone else who has the desired product or service and then trade. And then the last, we're going to look at the store of value. So it does hold some wealth in money form. And then money does have the advantage of liquidity. So liquidity is kind of like how fast you can get it. It's kind of like a good example. That's kind of more of like an accounting term. But like, so if you compare dollar bills to a house, right? Like, so how fast can you give someone money from the dollar bill compared to the house? Obviously, the dollar bill, as it would take some time to sell your house. So assets are measured through liquidity. So if you ever like want to open up your own business or anything and you go get a bank loan, they are going to look at your liquidity, right? So how much do you have in your checking, your savings, cash on hand, compared to what do you have maybe in cars, boats, stocks, houses, right? Because obviously, if your loan goes bad, they're going to know how can you pay this. All right, so M1. Now, what M1 is going to include is going to be currency. So this is all coins and papers money in the hands of the public. And you'll see a graph for M1 here in a second. It also checkable deposits at commercial banks. Now, other liquid assets, this would include checkable deposits at credit unions and other so-called thrift institutions, plus saving deposits held at either commercial banks or thrift institutions. Thrift institution is just kind of like a credit union. I believe from some research I did, it kind of started back in like the European or like early European. They called them thrift institutions just because they helped consumers better than like what a commercial bank would. So that's kind of like that kind of coined that term thrift institution. Anyways, now institutions offering check deposits will be commercial banks, thrift institutions again, saving and loan associations, and then your mutual saving banks and credit unions. Now, currency held by the Fed, commercial banks, and thrift institutions are going to be excluded from M1. Also excluded from the money supply are any checkable deposits of the government or the Federal Reserve that are held by commercial banks or thrift institutions. Okay, question 1 here. Refer to the table. Money supply M1 for this economy is. So it's going to be currency in the hands of the public, which is going to be 80. Your checkable deposits, which is 100. Your other liquid assets, which is just your savings deposits, will be 50. So that will give you 230. So A. Okay, question 2. In the United States, money supply M1 includes. I'll give you a chance to pause this and answer it. Yes, the answer here is going to be A. Coins, paper money, checkable deposits, and saving deposits. Now, coins are going to be issued by the U.S. Treasury. Currency is referred to as token money, which means the face value of the currency is unrelated to its intrinsic value. Now, the face value of the currency exceeds the actual value of the piece of paper that it is printed on or the value of the metal in the coin. So at one time, coins were actually made of valuable metals such as gold or silver. Today, those coins' actual values are worth more than the face value of the metal in the coin. Now, Federal Reserve notes. This is going to be paper money issued by a Federal Reserve Bank. Now, note that debit card balances are part of money supply M1, but credit card balances are not, because credit cards are technically a loan. Okay, so question 3 here. Debit card balances are part of the money supply M1, but credit card balances are not. Give you a chance to pause this and answer it. Okay, so the answer here will be true. Question 4. A $20 bill is a. I give you a chance to pause this and answer it. Okay, so the answer here will be D, a Federal Reserve note. And then question 5. Credit cards are defined as money because they facilitate transactions. I get a chance to pause this and answer it. Okay, so the answer here will be false. All right, now we're going to look at the money definition of M2. So M2 is just all of M1 plus what's known as near monies. So these are financial assets that are not themselves a medium of exchange but have high liquidity and can be readily converted into money. So examples would be like small denominated less than $100,000 time deposits. So these are just your CDs, your money market mutual funds. So this is the type of mutual fund that invests in low risk short-term securities. Now, money market accounts combine some features of savings and checking accounts, but typically the number of withdrawals are just going to be limited. I believe it's I know around Amarillo, I believe it's 6 at Amarillo National Bank here. Um, so it's kind of like a savings checking account invested into the market. So that would be a money market mutual fund. You're just not really allowed to take out withdraw a lot out of it, or you'd probably pay some penalties. Okay, so this is the graph. So this chart shows the distribution of M1 and M2, and it kind of helps illustrate the fact that M2 is just slightly larger than M1. So M1 will be your other liquid deposits, the savings, the checkable deposits, commercial banks, and then currency, and then your M2 up here. So your small time deposits like your CDs, and then your money market funds. But all of this is M2, but you can see that M2 is just slightly larger than M1. So what backs the money supply? So relatively, it's just guaranteed by the government's ability to keep value stable. The supply of money is going to be controlled by monetary authorities to ensure it retains its value or purchasing power. So why is money valuable? It is relatively scarce, it's a legal tender, and is generally acceptable in exchange for goods and services. And relatively, and just on top of that all, money is valuable because we say it is, right? So kind of like crypto. Crypto has a value because we say it is. Um, it used to be backed by gold, right? Like so, kind of back in the day, but that was hard, right? It's just people would go on bank runs. They would take their money out. You can't really move money around that easy with being on a gold standard, and so we kind of live this world like this, and it's been going good for so far. Hopefully, obviously, it continues. So reasons for not. So it allows for flexibility. If gold is still used, then the money supply would vary with the availability of gold. And then on top of that, you also have an increasing population as well. But so this just allows the government to put money where needed. Okay, question 6. United States currency has value primarily because it. I'll get a chance to pause this and answer it. Okay, so the answer here will be C. It is relatively scarce, legal tender, and generally acceptable in exchange for goods and services. So some advantages, disadvantages of fiat money. So our currency is known as fiat money. So advantages give central banks greater control over the economy. It's cost efficient to produce and provides government flexibility. But some disadvantages are it's not a foolproof way to protect the economy, creates the opportunity for a bubble, and it does provide risk of inflation. So the purchase power of money is the amount of goods and services a unit of money will buy. If the price level of goods goes up, the value of the dollar goes down in a reciprocal relationship. Now, periods of hyperinflation happen when governments issue so many pieces of paper currency that the purchasing power of each is totally undermined. So after World War I, actually Germany experienced hyperinflation that many historians believe contributed to the Second World War. Governments have a vested interest in ensuring stable money supply to keep the economy on a steady pace. So I put this in here. So inflation is relative when your prices go up, but your dollar value goes down. Alright, so the Federal Reserve is going to be the system that serves as the monetary authority that controls the money supply for our country. Now, Congress passed the Federal Reserve Act of 1913 to try to prevent problems in the banking system that had plagued the country earlier in the 20th century. Your Board of Governors are your central authority, so there are 7 members, 14-year terms that are staggered, so that one member is replaced every 2 years. Now, the paper money or currency in the United States essentially represents a debt to the Federal Reserve System. Money is produced under the Federal Reserve Act 1913, issues them to the Federal Reserve Banks at the discretionary of the Board of Governors. The Reserve Banks then circulate the notes to their member banks, at which point they become liabilities of the Reserve Bank and obligations of the United States. Okay, question 7. The Federal Reserve System was established by the Federal Reserve Act of. I already give you a chance to pause this and answer it. Okay, so the answer here would be A, 1913. Question 8. The paper money or currency in the United States essentially represents. I get a chance to pause this and answer it. Okay, so the answer here will be 8, or sorry, will be D, a debt of the Federal Reserve System. So there are 12 Federal Reserve banks. Banks amend the decision of the Board of Governors and are aided by the Federal Open Market Committee. So most countries have one bank, while the U.S. has 12. The banks are quasi-public banks, meaning that they blend private ownership and public control, seek the well-being of the economy, not a profit. Reserve balances, so this funds the commercial banks and thrift institutions. They hold on deposit at the central bank with the Fed. Now, after 9/11, the Fed lent $45 billion to U.S. banks and thrifts to ensure the stability of the banking system. Under normal circumstances, though, the Fed lends around $150 million per day. So this is just a snapshot of all the Federal Reserve banks in the United States. I actually have been to the one in Dallas back in 2019, I believe. It's a pretty cool place. They obviously didn't let everyone. We were there for an event, so we didn't like get to go in all of it, but just the entrance is really cool. They have like a whole museum in there, big lobby area, but it was really cool, really interesting place to go to. But I think what's like interesting is like California, like the one in San Francisco, like covers this much room where you have like a bunch of little ones over here. But anyways, this is a snapshot. You can pause it and check it out if you like. Now, the most common thrift institutions are going to be your credit unions. There are about 4,300 commercial banks and 7,000 or so thrifts. Now, in addition to being subject to the monetary control of the Fed, banks and thrifts are subject to regulation by various agencies such as the Federal Deposit Insurance Corporation and the National Credit Union Association. Both banks and thrifts are required to keep a certain percentage of their checkable deposits as reserves. Now, the Federal Open Market Committee, or the FOMC, aids the boards of governors in setting monetary policy and conducts open market operations. So this is a global perspective. Just the 12 largest commercial banks as of 2021. So you can see here, actually, China controls the top 4, and the U.S. does not hit until about 8 and 9. Now, the Fed does not set the interest rate that most people pay. It sets a discount rate that it charges to banks for short-term loans, which then contribute to the rate that the banks charge consumers on their loans. So they do not print the money. That task is still performed by the U.S. Mint. The Fed also acts as the physical agent for the federal government by collecting money owed to the government from taxes and assisting with the government spending of equally large amounts. The Fed makes periodic examinations to assess bank profitability, following regulations, and to uncover questionable practices or fraud. So going back here to this sentence, so it sets a discount rate that it charges its banks for short-term loans and then contributes to the rate that the bank charges customers on their loans. So just to kind of break that down, because that does kind of affect you in a way. So if you go and get a car loan, right, from a bank, so what the Fed does, and I believe you'll learn this in a little bit, but they go between so they use a 0.25 difference. So right now, the Federal Reserve rate is, I believe, 5.25 to 5.5. And that is what they are going to do with the banks, right? But what the bank does is they do what they call benchmarking. So they will take that 5.5 and they will add 3 to it. So benchmark plus 3. And you will actually, it is 4.25 to 4.5. That's right. So it's 4.25 to 4.5. And so they add 3 to that. And that's the prime rate is what that's called. So it's 7.5%. So they take the 4.5, the high end, add the benchmark plus 3, and the prime rate is going to be 7.5%. So 7.5% is the current current prime rate right now. So the majority of your banks that you go to, unless they're able to get around it somehow, if you have good credit, like the best credit there is, you're going to get that 7.5%. But if you have bad credit, obviously you're going to get a higher rate than that. But all the good credit, you get that 3 benchmark, right? And that's for your car loans, anything that kind of has like collateral to it. Obviously, if there's no collateral, you're going to be charged a higher interest rate. But that's this scenario right here. But that one does impact you kind of the most, right? Okay, so there are 2 types of federal agencies: independent and executive. Executive agencies fall directly under the control of the president and therefore may be prone to political pressures. Now, independent agencies do not report directly to executive branch of government. As an independent agency, the Fed tends to avoid the political pressures that Congress and the executive branch face that sometimes result in inflationary fiscal policies. This enables the Fed to take actions to increase interest rates in order to stem inflation as needed. So the Fed is going to be independent of Congress and the president, and they do not have to follow orders from either Congress or the president. Okay, question 9. The Federal Reserve is independent of Congress, and the president does not have to follow orders from either Congress president, so that would be true. Okay, so fractional reserve banking. So characteristics, so banks create money through lending. Banks are going to be subject to panics, but a portion of check deposits that are backed by reserves are going to be stored on site in the vaults of commercial banks and thrifts, and then kept at reserve balances on deposit at the central bank. So relatively, if you go deposit $100, the bank is allowed to take a portion of that $100 and lend it out. And then they have to keep a portion of that also on site. And that is kind of how the fractional reserve banking works. But that is how you create money in a way. So as soon as that new loan gets made, new money gets made. Okay, question 10. In a fractional reserve banking system, the portion of check deposits are backed by reserves are. I get a chance to pause this and answer it. Okay, so the answer here is going to be C. So stored on site in the vaults of commercial banks and thrifts and kept as reserve balances on deposits at the central bank. So your answer here is C, both A and B. Now the Fed can alter money supply by modulating incentives and restrictions it places on banks and thrifts. So when the Fed policy prompts banks to increase lending, access to credit is going to be easier. But the Fed policy which prompts banks to decrease lending can result in lesser volume of loans and higher interest rates. So decisions tend to change. The total amount of check deposit money, the overall money supply, and interest rates, and then the overall economic activity. Now, people hold money for different reasons. One reason is that it is convenient to have money available to purchase necessary goods and services. This is referred to as the transaction demand, or DT. Now, the larger value of all goods and services exchanged in the economy, the larger amount of money that will be needed to handle all of the transactions. And the second reason is the asset demand for money. So the money functioning as a store of value. People like to hold some of their financial assets as money because money is the most liquid of all financial assets. And then if an emergency arises where you need funds in a hurry, you'll be able to have access to those funds quickly. Just as a good note, it is best to always have anywhere between 6 months and 12 months of your living expenses in your savings account. That is just a good rule of thumb. You have to take every your mortgage, your rent, your car insurance, all insurance, all grocery shopping, any entertainment, going to the movies, going out, like every dollar, gas, right? Every dollar you spend every month, you need to times that by 6 or 12, and that should be the amount of money you have in your savings. The reason for that is if you or your partner were to get laid off, you have 6 months to find a new job, right? Or 12 months to find a new job, and then you build that money back up. So that is just, like, if you're ever curious, like, how much money should I hold, that is your answer. Okay, question 11. The asset demand for money is most closely related to money functioning as a. All right, get a chance to pause this and answer it. Alright, so the answer here is going to be C, store of value. Now, the disadvantage to holding money as an asset is that it is a non-productive asset. So if you bury a pile of money in the backyard, when you dig it up 10 years later, it will be the same amount that you buried, but 10 years later, the purchasing power of the money will have declined. Now, the amount of money demanded as an asset is inversely related to the interest rates. So as interest rates go up, the demand for money as an asset goes down, and vice versa. So to find the amount of money demanded for transaction purposes, you'll take nominal GDP divided by the average of each dollar spent per year. Okay, question 12. If nominal GDP is 850 billion, and on the average each dollar is spent 5 times per year, then the amount of money demanded for transaction purposes will be, so we'll take the 850 divided by the 5, and that gives us 170 billion. Alright, so just like in other resource markets, there's an equilibrium interest rate that will cause the supply of money available to equal the demand for money. So it's going to be determined by the intersection of the supply of money curve and the total demand for money curve. This rate can be thought of as a market determined price that borrowers must pay for using someone else's money over some period of time. So interest rates and bond prices are going to be inversely related. Lower bond prices will raise the interest rate and vice versa. Bonds pay fixed annual or semi-annual interest payments, but we'll discuss more of this in the next chapter. Okay, question 13. The equilibrium rate of interest in the market for money is determined by the intersection of the. I'll give you a chance to pause this and answer it. This answer here will be C, supply of money curve and the total demand for money curve. Okay, so there are 2 questions about bonds in this homework, but we do talk about bonds more in the next chapter. But for question 14. We're to find the maximum price. You're gonna divide the annual interest payment by the new interest rate, and then for question 15, to find the annual yield, you find the amount of the interest payment by multiplying the interest rate times the face value of the bond, and then when the market price of the bond rises, you find the new yield by dividing the annual interest payment by the new price of the bond. This is more like kind of finance related. So I go ahead and kind of walk you through all this. Obviously, if you go to a new university, right, like after Emerald College, you're gonna have to take finance classes, and you will be doing this way more. But at least maybe you'll have a little bit of knowledge going into that. Anyways, question 14. A few years ago, you bought a bond with no expiration and a fixed annual interest payment of $1,500 at a price of $18,000. If the interest rate in the economy is now 15% a year and you want to sell the bond, the maximum price that you can get for it is going to be, so we're just going to take the $1,500 divided by the 15%, and that will give us 10,000. So the answer here will be D. Okay, question 15. A bond with no expiration date that has a face value of 10,000 and pays a fixed 10% interest. If the market price of the bond rises to 11,000, the annual yield approximately equals. So we take the face value 10,000 times it by the 10% interest gives us $1,000. Take that 1,000 divided by the price it rises to of 11,000 gives us 0.9 times it by 100 and you get 9%. Alright, that is going to be the end of this chapter.